Corporate finance practice problem using Excel. Acquisition and coefficient of variation. Get ready, it's time to take our chance with corporate finance. Here we are in our Excel worksheet. If you have access to the Excel worksheet, would like to follow along, note that we're in the practice tab as opposed to the example tab. The example tab, in essence, being an answer key. Information's on the left-hand side. Going to populate that into the blue area on the right-hand side, looking at an acquisition type of situation where one company is thinking of acquiring another. In this case, A is thinking of acquiring B company. The expected earnings per share for B, the company to be acquired, whether the merger happens or not, we're going to assume to be 7. The standard deviation of the earnings, if there is a merger, goes from starting at the 2.9 to the 1.9, and this is going to be because the companies are negatively correlated. Now note, we've talked a bit about the standard deviation and the coefficient of variation and these kind of concepts in a prior section. We're going to apply them here to a situation with a merger type of situation, but remember, if you want to take a look at them in more depth, you can look at a prior section. We'll also talk about them a bit more in future practice problems in this section as well. But just a quick recap, note that we can think about the expected earnings as kind of like the average that we're looking at. We can think about the standard deviation and the coefficient of variation as trying to measure the distance from that midpoint that will be there. So if there's going to be more spread in the data, then it's more likely that we have points that are going to be further from that central point, which you would think would correlate in this context to more risk. So if we're going from a standard deviation of 2.9, you've got more spread from the data from the center point than you would think from the 1.9, and you would think that would basically result in more risk that would be involved. Why would it go from 2.9 to 1.9 if we're talking about a merger situation? Because we're thinking in this case of companies that are negatively correlated, which basically means if they're positively correlated, you think about a merger where two companies do essentially the same thing, then a merger could be good because then they could obviously do that thing quite well and they would be maximizing their potential when times the business cycle, the economy is good for that thing that they do. But in times when things are not good, then of course the whole company might, decline a little bit at that point in time. There's more risk that would be involved in a downturn for that particular business they're in. If they combine with a company that does something that's slightly different and they're negatively correlated, meaning when the environment is good for one, it's not as good for the other, and vice versa. It's similar to having basically a diversified kind of portfolio. When you're investing, that diversification could make the result of less kind of deviation or variance from the mean. The differences kind of net each other out, giving you some more security in that case. So that's the same kind of trade-off you have on a portfolio kind of situation. So let's calculate the coefficient of variation for B before. We're going to say the standard deviation they gave us. Let's say standard deviation was the 2.9. So we'll pick up the 2.9, add a couple decimals, number group, decimalizing it. And then the expected value, we're saying is going to be the 7. So we calculate let's underline that font group and underline, we get the coefficient of variation by taking then the standard deviation of the 2.9, in this case, divided by the 7 expected value, adding some decimals, number group, couple decimals, we're at the 0.41. Let's calculate the standard or the coefficient of variation after. We're going to say then we have the standard deviation. I'm just going to pick up the same number here. It's now at the 1.9, adding some decimals, number group, couple decimals, and then we have the expected value, which we're saying is the same here, underlining that by going to the font group and underline. That's going to give us our coefficient of variation, which is going to be the 1.9 divided by the 7, and number group, adding a couple decimals. And then remember that this coefficient of variation is generally the number that we're going to depend on oftentimes to think about the risk that will be involved. And so note, of course, it being lower here for this second option, or if the merger takes place, it being lower due to the fact that they are negatively correlated, would lead us to think that if you have the same amount of the expected earnings per share and you're looking at a risk-averse individual, they're going to like the fact that the coefficient of variation is lower for after the merger, and therefore the merger would be a good thing in that case. So in other words, because the expected earnings after merger are less risky, a risk-averse investor, and that's, most investors are going to be risk-averse to some degree. The level of risk-averseness, will trade off how much risk are you willing to accept in order to achieve a potentially higher gain. So a risk-averse investor might be willing to assign a higher price-earnings ratio to the earnings due to that fact. All right, so they're going to say, once again, the expected earnings are the 7 here. Either way, the second option is going to result in a coefficient of variation that is less due to the merger taking place, which are negatively correlated companies. So when you're thinking about someone who's a risk-averse investor, the fact that there's less risk and you have the expected earnings per share the same means they might increase the PE ratio, meaning assign a higher basically market price compared to the earnings, given the fact that the risk is lower after the merger than it would be before.